Good morning, everybody, and welcome to our first webinar series on the topic of sustainable investing here to stay. It's exactly 10 a.m. Swiss time, and I see lots of people dialing in, so I will give it 30 seconds, 1 minute before we start, and then we'll kick off the content of that webinar. So bear with us for like 30, 40 seconds until people can join. Okay, good morning, everybody. So it's 10:01. I'm kicking off our new webinar series this morning on the topic of sustainable investing here to stay. Maybe a small logistical information before we start. When you are not speaking, please go on mute and turn off your camera for the webinar to record properly. And when we move to the Q&A session, you can, of course, turn on your camera again and jump in for the conversation. Maybe a quick intro on my end. My name is Romain Roy. I'm a director with SSF since around 1 year now, joining from the financial services industry. And I will be hosting today's session on moderating the Q&A session that we have at the end of the event. Before we jump now in the substance of today's presentations, I would like to hand over briefly the floor to Sabine Debelly. Sabine is the founder and CEO of SSF, for her to give us a few welcome notes, and we'll then jump into the presentations of our two guest speakers. Sabine, over to you.
Thank you, Romain, and good morning to all of you. And exactly, we also moved the slides. So I'd like to give you a brief introduction on why we started this series of webinars on sustainable investing here to stay. I think, and I can speak from my own experience, for sustainable finance professionals, the environment has become increasingly challenging over the past year. You are often confronted with high complexity in implementation, and sometimes you may feel that you primarily work for your compliance department, not for your clients. Also, in phases of general budget cuts, sustainability departments are often subject to even higher reductions than other departments. And on top of it, we hear critics, many of them had kept silent in the previous years, that start to raise their voice again more prominently. And they often state that clients weren't even interested in sustainability at all. And last but not least, you're always reminded of the great performance of oil and weapon stocks over the past years, two sectors which are usually underweight in sustainable portfolios. At SSF, we think that in all of this, something important is missing, namely the business case of sustainable business decisions. I find it quite impressive how right now in daily news, we see how sustainability risks are increasingly materializing in costly damage. Houses are buried under mountains. Production is interrupted because factories are flooded, and conflicts and social unrest hamper global supply chains. These risks, they won't go away. Instead, I'm absolutely convinced that they will increase over time. Addressing them in a targeted but also in a pragmatic way is, in my view, the basis for long-term business success. So we decided to start a series of webinars which will bring some of these business arguments to you. With this, we aim to support you in leading internal discussions in which you have to defend the case for sustainable investing. We see many reasons why sustainable investing is here to stay. They range from performance effects, more effective risk management, better client dialogue, all the way to fiduciary duty. And in times when US asset managers move away from sustainable strategies, it is even a business opportunity for you. We all know it's not always easy to bring it all down to business arguments, especially putting them black on white. Often it's methodologically difficult to prove the benefits, and some of the benefits will materialize only over the long term. But we are convinced it's just common sense to take ESG factors into account when investing for the benefit of your clients, but also for your long-term business success. Now, in this first webinar, we cover topics on climate risks and performance, but also we bring more general arguments for sustainable investing in a time of a perceived ESG backlash. I very much look forward to the input from our speakers and to what they have to say on these topics. So I wish you an inspiring session. Thank you.
Thank you very much, Sabine, for the welcome note. Maybe before we hand over to Guido and to Christopher, a quick reminder for all of your participants on today's agenda. So we have two prominent speakers for today. We have Guido Giese. He's the Global Head of Sustainability and Climate Solutions Research at MSCI, and he will give us the first presentation on the topic of financial materiality of the energy transition. It will be followed by a presentation by Chris Greenwald, who is the Head of Sustainable Investing at LGT Private Banking, on the ESG backlash, as Sabine indicated, on the potential response of opportunities for private banking in Switzerland. As you can see on the agenda, we have reserved ample time for Q&A. This is on purpose, so we kept the presentation relatively short, half of the event, and then we have almost half of the event just for questions from you. So be ready to ask questions if you want to get into a topic more deeper, if you want to go into something, if you want to verify that you understood something that Guido or Christopher said. That's the opportunity, and that's really the purpose of the second half of the event. Without any further delay, let me hand over to Guido for his presentation. Guido, if you can, please share your screen and unmute yourself. If you have any technical issue, we'll be there to help.
Yeah, great. Thank you, Omar and Sabine, for the invitation today. I hope you can see my screen and hear me. Otherwise, you have to give me a sign. You can see my screen, right?
Yes, we can see it. Maybe
okay,
you can go on full screen mode.
I go in full screen. That's a good idea. No, thank you for the invitation. It's really great pleasure to be here, because I've been based in Switzerland for almost 23 years. So Switzerland is always kind of my second home. I'm now based in London to head the global team on sustainability and climate solutions research team at MSCI. But I would like to give you a brief overview of how we tested the financial neutrality of our data for the energy transition. And this was really a question coming up in the last 1.5 years during this backlash on ESG and climate data, where there was a lot of negative press and a lot of clients asked us, look, guys, we know the energy transition is happening, but is the data useful to manage portfolio risks here? And especially in the US. In the US, we had conversations with large asset owners who said, we believe the energy transition is relevant for us, but we need the scientific proof that climate data can help us to make better investment decisions. Because with the current political debate in the US, it's very difficult. You need to be able to justify using climate data for investment decisions. And the key thing is, and I had a Swiss client who summarized it really nicely. A Swiss client told me, look, guys, we are frustrated with this narrative of, oh, let's use forward-looking climate data, because forward-looking data doesn't exist. Data is always backward-looking. What we need are predictive indicators. We need to find leading indicators that have empirical evidence for predictiveness in portfolio construction. We said point taken, and I like that approach because I'm a quant by nature, so I have a PhD from the ETH in Zurich. So I like this type of from feedback from clients. I said, okay, let's look at this. Let's look at it the scientific way. How does the energy transition happen? What data sets can be used to identify the transition? And can we find empirical evidence that these indicators are leading indicators? So there's some predictiveness in there. So we said, okay, step one, how does the energy transition unfold? So companies going through a transition, they go through different stages, right? Stage one, they need to change their corporate strategy. They set climate targets, climate governance needs to change, compensation of the board or of the senior management might need to change. And we have data for that. We have climate data, we have corporate governance data linking to that phase. Second phase, they need to invest differently. There needs to be CapEx. There might be green patents or other indicators showing that the company is doing something differently. In the next phase, their earnings model needs to change. Fossil fuel revenues need to go down. Clean revenues, green revenues need to go up. And obviously, you want to see emissions coming down. So we have a lot of data. The question is the data decision useful? So can we showcase that you can make investment decisions based on these data sets because they might serve as leading indicators? And to identify leading indicators, it's important to understand the economic transmission channels that companies go through and where each data point might fit. But so basically we said, okay, let's run some numbers here. Let's run our models on this one. And basically, so we said, okay, we take a lot of data. I'm just summarizing it briefly. We had target data. We had management governance data around climate transition. We have green indicators like CapEx, green revenues, emission-related data and emission trends. We have climate risk indicators. We have actually a longer list of indicators. I'm giving you a brief summary of what we tested. But if anyone is interested in a longer version, as I said, I had one client who asked us to do a 90-minute version of this with all the stats, all the formulas, all the regression, all the p-values. So we have that ready. If anyone interested, I can take you through all the details. But I'm just giving you a 7-minute summary of what we did. We tested two things. We tested whether, if we go back 3, 4, 5 years ago, and we look at which companies had targets, good governance, green indicators 3, 4, 5 years ago, did they decarbonize faster 3, 4, 5 years afterwards? So we did do the kind of causality test. Data in the past, would that have predicted something for emission performance and for financial performance? So we're going back in the past saying, okay, would the data have predicted? So we really want to find the empirical evidence or assess whether there is empirical evidence. And I can quickly summarize these two tests we did: emission performance, so emission progress, financial performance, because our clients are interested in both. Now, showing you one example, we have a so-called low carbon management score that we've published for years and used in index construction for years. It's a subcomponent of our ESG rating model, and we have a long track record for it. That's why it's a nice indicator to use. So we went back to 2018, look at the data we published 2018. We took the global benchmark, ACWI, and grouped it into companies that in 2018 had a very good score, median and low score. So we have terciles. The terciles are equal weighted because we don't want NVIDIA or Apple to play a huge effect. And then we checked 5 years later the realized emission performance of that scoring terciles. And we saw there was a clear signal. So higher scoring companies had clearly a stronger decarbonization rate. And we tested different governance indicators, but governance was one of the indicators that really worked well, where we see over 5 years, 4 years, 3 years horizon, we did find a predictive signal. Similar to SBTi targets, we tested different types of targets. SBTi is one. On the right-hand side, we did find that companies with SBTi did decarbonize faster, but we cheated a bit on the right-hand side because 5 years ago, there weren't enough SBTi targets. So we looked at SBTi targets during the past 5 years. So you could argue there could be a bit of forward-looking bias in there, fair enough, but we will test the data every year. And at some point, we will have enough sample size that we can do the proper forward testing, like we did from the carbon management score. We also tested a lot of data that is sector specific. For example, for some sectors like the utility sector, we have green CapEx data with 3 years history. Unfortunately, only 3 years. It's the longest history we have. It's the utility sector. We have green revenue history as well. And we tested whether in utilities, higher green revenue share, higher green CapEx share 3 years ago would have predicted faster decarbonization. The answer is yes, it would have. So we found a lot of empirical evidence and the statistical confidence was there. So we tested the confidence level, it's there. There's also data where it was disappointing, to be honest. In materials, it was difficult. Apparently, the materials sector isn't transitioning yet. It's harder to find empirical evidence. We also found it harder to find evidence that track record in emissions was a leading signal. So we tested 3 years ago, companies that had already a good track record 3 years ago. Would that have predicted a continuation of good track record? Very weak evidence. So not every indicator worked equally well, to be very honest, But all in all, I think we got a very clear picture that there is climate data that does serve as a leading indicator. Some of it has been to be used in a very sector-specific way. Now, this was one side of the testing. The other side of the testing is climate data relevant for risk and performance? That's the evergreen question. And there's thousands of research papers on that. They all disagree. Nobody really knows, is carbon emissions good or bad for performance? I think we found the answer to that one. And we launch a research paper on this one soon. But basically, what we came to realize, we need to rethink this a bit. Because I think there has been a very common idea, a misconception, that the total carbon footprint of a portfolio measures your transition risk. And that's not the case. The total carbon footprint of your portfolio measures your climate impact. So it measures the emissions that you're financing and the bad stuff you're financing, basically. It doesn't measure your transition risk. The reason is carbon emissions were risk-free for 200 years. Yeah, you could pollute as much as you wanted. Nobody punished you for it. That has changed, but it hasn't changed in the way that every ton of emissions is putting an economic disadvantage at you. There's still a lot of emissions that are practically risk-free and will be risk-free for a while. On the other hand, there are emissions that put economic pressure on your portfolio because there is a carbon tax in the EU. There is a fleet tax on the downstream emissions of car companies. There are technologies that are crowding out some old fossil fuel technologies. So basically it means to measure climate risk, we need to become more specific. We need to carve out those emissions that at the moment expose you to risk and differentiate between emissions that might not expose you to risk at the moment because there's no economic pressure on it. So we have a materiality weighted footprint that looks at the risky part of footprint where we see immediate pressure, but we also see transition risk elements not linked to carbon footprint. For example, the European automobile sector. Look at Volkswagen. What's the biggest transition risk of Volkswagen? It's not their emissions. It's their lack of technology exposure and business readiness, right? I mean, Volkswagen lacks the technology that BYD has in batteries. It also lacks the business readiness in selling EVs at cost parity. So we need transition indicators that go beyond carbon emissions. And we tested that. I'll just give you a very brief overview. One thing is we tested the difference between a total carbon footprint and a materiality focused carbon footprint in our risk model. So this is a bit technical, but I think, you know, factor models where we have Barra factor model where we have value, size, momentum, all these factors in there. And we put carbon efficiency into the model to ask, does carbon efficiency capture a factor, a performance premium after controlling for all other factors? On the left-hand side, I'm starting with scope 1 and 2 because we have longer history. For scope 3, we only have 4 years, but we tested both. But this is scope 1 and 2 where we have 10 years history. And we found that if you use the total carbon emission intensity, it's a very weird picture. In some regions, the greener companies tended to outperform. In emerging markets, they underperformed. So it's a mixed picture, and it depends on the weighting. If you cap weight, there's a bit more outperformance. If you equal weight, it's just noise. So I understand why academia isn't clear on that. It depends how you test and which region you test. But then we carved out a materiality weighted carbon footprint. So the footprint that is at risk today through economic pressure points like a tax or a rivaling technology. And there was much clearer evidence that the market is pricing it. So there's much clearer performance difference. So the greener companies have been doing better than the browner companies across regions. We found an even bigger difference in scope 1, 2, 3, and even bigger difference when we looked at the earnings performance. So earnings performance was even bigger. So, and that gave us a very important lesson learned here. Going back to what the American client said, we need to be more specific in how we find risk signals. And what it means is when we look at carbon emissions, I'm just trying to go to the next slide. When we look at carbon emissions, it's a really nice, carbon emissions is a really nice example that you need to use the data in a use case specific way, because carbon emissions are often said, oh, carbon emissions are backward looking. It's actually not true. Depends on the use case. So carbon emissions is a lagging indicator for pollution, right? Because the carbon emissions are typically 1-2 year reporting lag. So the carbon emissions you get today from MSCI are kind of backward looking. You see the pollution of the past. But at the same time, if you carve out those emissions that are currently under business pressure, it's a leading indicator for risk. And the market has been pricing it as a leading indicator. We see that in the risk model. And the same goes for other indicators. The same goes for green revenue share, for example. Green revenue share is one of the indicators that a lot of clients like to use, but green revenue share is the same as carbon emissions. Not every dollar of green revenue share has the same business opportunity. There are green technologies that currently are running at cost parity and are scalable. Huge opportunity. There are green revenues coming from green technology, which is not running at cost parity and is not scalable. Not much business upside at the moment. So what we also did for green revenues is we carve out green revenues that are likely exposing you to opportunity because the technology at cost parity is scalable versus green revenues that are not there yet. It makes a huge difference also in terms of how the market is pricing it. So the lesson learned here is, and I have to say, there is a big backlash on ESG and climate data, especially in the US. But I had a very positive experience here with US clients because they challenged us. They said, look, guys, you need to do a better job in carving out the investment signals here. And that challenge was a very healthy one because we learned a few lessons here. We learned the lesson that, yes, we do find clear empirical evidence that climate data beat carbon emissions targets, green revenues, CapEx patterns, climate governance indicators. They serve as leading indicators for either decarbonization or financial risk, but you need to be more use case specific. So instead of just taking all the scopes of emissions, be aware that the different scopes expose you to risks differently. In some sectors, we think the scope 3 downstream emissions expose you to risk, scope 3 upstream doesn't. So be specific in what you test. But it also means is we think we have clear empirical evidence that the market has actually done more pricing of climate than many researchers thought, because many academic researchers and practitioners have used the total carbon footprint in risk analysis and haven't found much. Of course not, because the market is too smart for that, right? The market sees the difference between carbon emissions that are at risk because there's an EU carbon tax on it versus emissions in China where you might not have a exposure to risk at the moment. So the market does see these differences. So our indicators, they also need to see these differences. So specificity is needed in implementation. So that's the big lesson learned. As I said, this is kind of just a summary. If anyone is interested in a longer version, we have a lot of research on that with formulas, T-stat, and so on. But let me stop here because I think I've been sharing a lot, and I want to hand it back to Romain.
Guido, thank you very much for this introduction to your research. Very nice timing of 15 minutes, and I know you have probably to rush a little bit through some of the content, and I guess in the Q&A, we may have time to go a little bit deeper in some of these very interesting insights you shared. So that's very good. Thanks a lot, Guido. Without any further delay, let me hand over to Chris. Chris, please try to share your screen if you can. And again, if it doesn't work, we will be here to help. And then I will take over at the end of your presentation for the Q&A. Thank you. That works. We can see it.
Okay, it's presenting fine?
Yes, looks very good.
Okay, thanks a lot. Thanks, Romain. Thanks, Guido, for the very insightful studies that you've done on climate risk. If I just move to the next slide here, I'm going to be speaking in my presentation more broadly about the ESG backlash. And how financial institutions and private banks specifically can respond in presenting sustainable investment strategies. I'm going to start by explaining what do we mean by the ESG backlash and demonstrate its effect through asset flow data. Then I'm going to summarize 3 key ways of responding. First, I'm going to argue that banks should return to the economic fundamentals that made sustainable investing strong with institutional clients by focusing on how ESG can enhance risk-adjusted returns. Second, I'm going to talk about how banks should focus on the risk management aspects of ESG and talk about how sustainability should be seen within a context of long-term investment themes. And finally, I'll argue that banks should link sustainable investment to their overall strategy and see the backlash not only as a challenge, but also as an opportunity. So to begin with, it's important to remember that regardless of developments in sustainable investing, the long-term environmental challenges are becoming ever more urgent. The planet has reached record levels of CO2 emissions, and we're already in the process of surpassing 1.5 degrees of global warming. And while companies and governments responded following the Paris Agreement with a range of net zero commitments, we've seen a number of steps backwards in the past few years. Policy has become a lot more challenging in the United States. And within the financial sector, many large US asset managers have left collaborative engagement programs such as Climate Action 100+, and most large US banks have exited the Net Zero Banking Alliance earlier this year. Even in Europe, we're seeing challenges with the EU's Green Deal finance strategy and with the Omnibus package. So now it's important within this context that sustainable investment reestablishes a firmer foundation independent of the changing regulatory and political environment. So before talking about the ESG backlash, I think it's important to put it in the context of the long-term growth and success of sustainable investing. From early 2018 to today, the assets in sustainable investment strategies have grown by a factor of 6 times. Starting in 2022, within the context of the Russian invasion of Ukraine and increasing energy prices, we started to see attacks on ESG investing in the US, which was reflected in outflows in sustainable investment strategies in the US. Positive flows in Europe counterbalanced these outflows over the past 2 years, but we're also seeing a retreat in Europe. And in Q1 of this year, we saw the first quarter of combined outflows in sustainable investment strategies in both US and Europe. Now, Europe is particularly important because the European market makes up 84% of the total assets in sustainable investment strategies, according to data from Morningstar. And challenges in Europe have come from a number of shifts in the changing EU regulation. In 2023, we saw many funds reposition from Article 9 to Article 8 as a result of the EU's rule that Article 9 strategies needed to have 100% of their holdings as sustainable, which was impossible for most index strategies to meet. And this year, we're seeing another set of challenges with the ESMA fund naming guidelines, which has led a large number of funds to either drop the terms ESG or sustainable or to find alternate names. Within the context of the evolving EU guidelines and regulations, as well as greenwashing concerns, it's important that we have a solid foundation to present sustainable investment strategies to clients, showing their long-term benefits. Now, the first and most important way to address the backlash is to go back to the basics of fiduciary duty and focus on the financial material case for sustainable investment. Broadly speaking, there are really 2 distinct ways and motivations underlying sustainable investment. The first approach, which was the original foundation for institutional investors, focuses on how sustainability factors impact companies. It's focused on the most financial material KPIs to measure how companies manage and respond to sustainability issues. It tends to be best in class and industry neutral, and is primarily concerned about how sustainability impacts a company's long-term business and ultimately financial performance. The second approach, which has been the orientation of the EU's regulatory regime, focuses on the impacts of companies on the environment and society. It's oriented around how a company's activities and products impact the world. It can involve exclusions of certain industries, and is mainly concerned with environmental and social questions rather than how sustainability can enhance investment returns. While the EU regulation has led the industry to have a focus on the second approach over the past few years, it's important to re-emphasize the first approach, which preceded the regulation. And this foundation provides a better justification for integrating ESG into financial strategies, and it can help make sustainable investing more attractive for a wider range of clients. It also goes back to the basis which made sustainable investing so successful with institutional investors prior to the EU's regulation. Now, there are many studies that one can draw upon to show the evidence of the positive financial impact of sustainable investing, including what Guido showed earlier. And I'll reference on this slide one particular study also done by Guido's team, which is quite insightful on the topic. And this study compared ESG leaders with laggards, and they were able to show that ESG can be considered a financial factor like other traditional financial factors. The other interesting thing from this particular MSCI study was that ESG had different impacts depending on the particular time period. Environmental factors were particularly important from 2016 to 2021, while social factors have become increasingly important since 2020. What's clear is that the combination of E, S, and G played the most consistent role as a positive financial factor. Now, while these studies clearly demonstrate the importance of ESG within a portfolio or index context, it shouldn't mean that the price performance of any particular company is driven by ESG alone. Individual stock prices are determined by a wide range of factors, including momentum, geography, size, and industry valuations. But they do clearly show that in aggregate, ESG factors reflect unique information that should be integrated with other financial factors in any robust investment process. Now, given the need to integrate ESG factors with a wide range of variables, I think it's very important to show clients how sustainability fits into the overall investment process. At LGT, we demonstrate that our focused sustainability mandate, which selects leaders in sustainability, follows the same strategic and tactical asset allocation, instrument selection, portfolio construction, and risk management processes as all of our portfolio management mandates. Sustainable investing should be presented not as a distinct strategy, but rather as a specific focus within the portfolio management process, which investors can choose in the same way that they can choose a Swiss or European or high dividend investment strategy. By doing this, clients can understand that sustainable strategies are a specific approach within the overall portfolio management process that includes all the other important elements that are needed to generate returns and to reduce risks. And focusing on the financial materiality of sustainability, a second important approach to respond to the ESG backlash is to remind clients of the wide range of material factors that sustainability includes. ESG factors cover a broad spectrum of issues across environmental, social, and governance, and I've listed a wide range of issues that the LGT sustainability rating that we use internally covers. These metrics help to identify how companies effectively manage sustainability risks. It gives insight into management's focus on long-term issues and stakeholder relations, which serves as a positive measure of the overall quality of a company's management, probably the most important element of determining any company's valuation. In addition to assessing risks, sustainability issues underlie many different drivers of growth. Issues like the circular economy, water infrastructure, the increasing needs for reliable energy sources. They're all long-term megatrends which will drive demand for products and services, and companies positioned to meet those demands represent compelling long-term investments. On this opportunity side, sustainability should not be listed as a distinct topic independently from one's mainstream thematic research. It's important to highlight how sustainability aspects are relevant across a wide range of long-term investment themes. And on this slide, I've showed the thematic framework that we use at LGT, which highlights 20 different long-term investment opportunities. And while not all of these themes intersect directly with sustainability, the majority of them have an overlap with sustainability topics. Embedding sustainability issues within the overall thematic framework that's used helps clients to see the range of megatrends and how sustainability issues underlie many of the key drivers for future growth. On this slide, I've highlighted a number of the thematic research reports that our team has provided for clients over the past year. All of them highlight companies that are well positioned to grow and which represent long-term investment ideas. By emphasizing how sustainability is part of the overall thematic research agenda, clients can better understand the financial materiality of sustainable investment topics. Now, finally, and maybe most importantly, in addressing the ESG backlash, it's important for financial institutions to make a clear link between their sustainable investment offerings and their own long-term corporate strategy. Clients interested in sustainable investment want to work with financial institutions that they believe take it seriously. In light of greenwashing concerns, it's especially important that these clients see that sustainability is not driven by commercial or marketing interests, but that it is consistent with the values of the institution with which they are investing. For private banks, it's also important that sustainability is integrated into the primary and core investment offering for clients. Clients come to any bank expecting to receive the best advice about how the strategies which the bank offers are the most relevant to preserve and grow their wealth. Consequently, if sustainability is material to the investment thesis, it needs to be integrated into the primary core and default offering for clients, rather than something that clients must opt into as a different offering. And doing this serves as an alignment of interests between the sustainable investment principles of the bank and its clients, which is critical to developing trust and maintaining a long-term relationship. Sustainability, from our experience, is probably the most important issue upon which to engage clients. We've seen that climate change in particular is an issue that resonates with investors around the world. Over the past 2 years, we have organized 2 successful client conferences on the topic of climate change, both in Europe and in Asia. We invited leaders across politics, science, and finance, together with over 300 clients, to discuss not only the challenges facing us, but also strategies that investors can take. Beyond developing specific investment products, probably our greatest and most important impact as a private bank is by engaging clients directly on these issues and openly discussing with them opportunities they have to address them in their investments. And finally, I want to conclude by considering the ESG backlash not only as a challenge, but also as an opportunity. We've recently seen 2 high-profile examples of institutional clients that have shifted their mandates based on sustainability underperformance of their manager. Both Denmark's Academic Pension Fund and the £33 billion UK People's Pension Fund announced that they were switching away from their managers that were performing poorly on sustainability and climate change. So while we have seen the effects of the attacks on ESG in the US, we're likely seeing the early stages of institutional investors reacting against managers in the other direction. And if anything, the backlash and retreat from sustainable investing allows many banks that have taken it seriously to stand out and differentiate themselves. It's when the market is turning against ESG that one can begin to see the institutions that are committed and that truly believe in the importance of sustainable investing over the long term. So just to conclude, I think it's important that we see the ESG backlash in the wider long-term context of the growth of ESG, and remember that ESG became an object of criticism partly because it became so successful and sizable over a short period of time. Keeping this in mind, the ESG backlash nonetheless does pose challenges. And I think there are 3 ways that banks can strengthen their positioning with clients. First, reemphasize the material financial case of sustainable investing for making better informed investment decisions and enhancing long-term risk-adjusted returns. Second, emphasize the way in which ESG factors can both manage risk and identify long-term growth opportunities. And finally, relate sustainable investing back to your bank's long-term strategy and values. In the context of the long-term growth in sustainable investing, the backlash is indeed a period of consolidation in the industry, but it's also an opportunity that will help us to return to basic principles, clarify the justification for sustainability, and establish a more robust foundation for future innovation and growth. So with that, Romain, I think I'll hand it back over to you.
Thank you very much, Guido and Christopher, for walking us through the so many insights in such a record time of 31 minutes. So to summarizing again the challenges on the context of the ESG backlash, the financial materiality of the transition, under which conditions you can find some reliable predictive indicators for financial performance, and also which options are available to Swiss market players specifically to respond to the backlash and potentially to make it a commercial advantage, like in the example of the UK People's Pension Fund. So thanks a lot for that in this very short time. We have now 20 minutes remaining in our session, which on purpose is set often for Q&A from the audience. So anybody I would like now to open the floor to you, please feel free to raise questions to Guido and to Chris to dive deeper into specific topics. When you want to raise a question, please just unmute yourself, put your camera on if possible, and introduce yourself very briefly. I'm going to now open the floor for anybody's questions.
Can I ask a question?
Great.
Thank you. This is Emerson from UBS. I just want to know if you see a move into a greater focus on transition investments. It's kind of moving away from the ESG as kind of being a bit toxic at the moment. So ESG terminology and kind of transforming that into opportunities for investors labeled under the transition framework.
Well, I can answer from an MSCI perspective. The answer is yes. I mean, there's huge demand in that sense, and the research testing I showed you has also led to a completely new data set that we've launched. It's called our Energy Transition Framework, which actually launches in 2 weeks. And what we've done is basically take the data, as I said, emissions and green revenues and so on, and carve out transition indicators. So we're launching a set of indicators that sit on the data where we have clear empirical evidence for transition in terms of decarbonization, but also in terms of financial opportunities and risks. So, and the reason why we did that, as I said, it was client driven. It was asset owners globally, US, Europe, and Asia asking us for more specific transition indicators. Now, coming on the ESG side, the funny thing is on the ESG side, the name ESG has become a bit toxic in the US, but funny enough, we see the same happening there. We have a lot of clients in the US that have been used our ESG ratings as a risk indicator, and Chris has shown this nice chart. And the funny thing is what US clients told us, we still want to use your data, but we want to see it in a more granular way, and we don't want to call it ESG anymore. So what we're doing is we have a lot of data under the ESG rating, which is risk focused. If there's key risk indicators under the ESG rating model, and we repackage it into data sets that align with corporate risk assessments. We have data sets we call operational excellence of companies and corporate governance. So we repurpose, rename it. You could say rename it, just for the sake of still serving the same client. So it's a bit of backlash in name, but not in purpose in the US, especially for the well-informed US clients.
I guess from our perspective, we've also seen quite a bit of interest in this topic because clients intuitively understand the case for improving companies and the potential alpha generation from those examples. And so we have launched a transition equity and transition bond fund to kind of meet those demands. I think from the sustainability perspective, it's really important that it's supplemented by a robust engagement program, stewardship principles, proactive voting to demonstrate that you really are ensuring that companies are making improvements and that you're encouraging them to make the right improvements in the right way. So certainly a lot of interest, I would say, as a development over the past year or two in this whole transition topic.
Thank you very much, boss. I have seen a couple of hands raised in the audience. I'm going to hand over to people who raised their hands formally. Maybe starting with Mathilde Lemoigne, if I pronounce it properly.
Yes. Hi, everyone. I'm risk control for Microbank, sustainability risk control for Microbank. My question is a bit more on the academic side of the talk. you, Guido, your study uses time effects. I mean, the whole point is to look at whether having a good indicators, say 3 to 5 years before, will lead to good performances, both in terms of carbon emissions and financial performance. My question is then, are we worried that the backlash that we're seeing now will affect both your left-hand side and right-hand side variable, and then potentially murky the actual predictive power of all those variables that we're now using for risk management, for example?
Yeah, no, that's a good question. I mean, I think it is true that and we do see that already, for example, on SBTi targets, right? That some companies are stepping out of SBTi targets, which means that if you had the anticipation that an SBTi targets gave you a signal, and then there's some room for disappointment, especially on the, I would say, on the emission pathway side, because when there is less political support for an positive emission pathway, there could be disappointment. On the financial side, I would say, on the financial side, I feel more confident. The reason is, when we look at the new framework, the new data framework that we launch in 2 weeks' time, is actually taking care of that. So in the new data risk assessment framework that we launch, we are making a huge step away, as I said, from just looking at total carbon footprint, saying that's your risk. We're looking at carbon footprint where we say there's clear indication that there's business pressure on it, either through policies or through technology replacements. And we are looking at other indicators that are very relevant and not directly linked to carbon emissions. For example, we have an assessment of which technology, we have over 100 technologies, so batteries, EVs, and sustainable aviation fuels, carbon capture, and we, for over 100 technologies, we have an assessment how likely these technologies are to make money for companies, meaning, are they operating at cost parity? Can they scale? Are they legally approved? And I think that will be independent. I think the technology part will become more important. And I think that's where most risk assessment has been underinvested in, I would say. So we're really tilting away from just looking at carbon emissions, more towards the business implications, what businesses can operate at cost parity in a transition world with new technologies.
I saw another question, another hand raised earlier from Ratanatra. On apologies if I don't pronounce that properly.
No worries. Hi, this is Ratana from Cambridge Associates. Thanks very much for the presentation. I have a question for Guido. Very interesting example that you're showing on, as far as I understood you correctly, taking it as a subset of the data that are material for prediction. And you said it's case specific. Can you give like other examples? Just like I just like see the risk of, say, okay, you're taking a subset of data and it's case specific. So you see the risk of like the blame of just choosing or messing with the data just to re-engineer the results that you would like to see.
No, I think we haven't done any back testing loops to fine tune it. So we have ESG sector analysts, right? So for energy, utilities, automobiles, and so on. And we asked the sector analyst in each sector which carbon emissions, which scopes of carbon emissions are the most relevant, putting companies at risk. And so we're actually choosing a scope for each sub-industry, or we choose a scope that we don't want to include. And the reason for that is because the reason is different scopes of emissions are additive when it comes to measuring impact. They're not additive in terms of risk. If you have a strong risk indicator and a weak one, you add them, you dilute the strong one. So for example, in the automobile sector, we are saying we only take the scope 3 downstream emissions of autos. The reason is we think that's the strongest risk indicator. Of course, there could be operational emissions as well that are at risk. But again, there could be a dilution. Also, the upstream emissions of automobiles, we're saying, yes, there could be some very indirect risk exposure, but if you add it, you dilute. Let's focus on the strongest. Same energy. Energy scope downstream is super important, obviously. I mean, energy sector is an obvious example. But for example, overall, we take out the biggest corrections on upstream emissions. We see very few industries where we think upstream emissions are imminently at risk. There are a few exceptions. Food companies, we think through agriculture, there is an upstream risk. So we do take some upstream emissions, but we filter out. But basically, when you take the whole carbon footprint, scope 1, 2, 3, I think we're taking out a little bit scope 1 and 2, but I think it's roughly 20%. We're taking out 40% scope 3 downstream, and we're taking the majority of scope 3 upstream out of the picture, saying we think there's too little imminent risk to expose the company in a material way and for the market to price it. But it's really subsector specific.
Okay, so when you say like it's case specific, you mean like subsector and perhaps like
big subsector,
regional,
and regional.
Okay.
Yeah, it's also regional diff. Yes.
Okay.
And we do update, and we also have an assessment now of policy pressure, where we say what is the policy pressure in each region, each country, and for each company we break out its revenues into countries and say what's the policy pressure, and we update it yearly. And for example, we're launching the model in 2 weeks, and we had to update the model already on the fly because of Trump. We realized policy pressure in US is going down, so we had to re-engineer the model already around that. So it's very region and sector specific, yes.
Okay, thank you.
Thank you, Guido. I see another hand raised by Hortense.
Yes, hi, thanks. Hortense Suez, Head of Sustainability at Bank CIC Switzerland. I just had a question regarding more towards clients for asset management, wealth management, in the sense that, and apologies, I'm in the train, so you might hear background noise, but I was wondering in terms of the argument that we get from front office people and from clients in terms of, okay, it's all good to have ESG and sustainable products, but what we want is performance first. So my question was, you know, what kind of I would say data you would have, concrete data in terms of investment products being, in terms of performance for investment products, and then maybe for Christopher, maybe probably in terms of how you counter that argument.
Yeah, I can answer from MSCI side. As I said, we are launching a new data set in 2 weeks because we got exactly the same question. So 1.5 years ago, we got a lot of questions around transition that we need to bring more evidence-based, but there was one question I forgot to mention. It's exactly what you mentioned. We had clients saying, look, guys, MSCI has a lot of climate data on alignment, right? Which companies are aligned or better aligned. But then clients said, look, guys, alignment does not mean better performance, right? We see the Volkswagen example. Volkswagen said they want to be the fastest transition company in EVs. Well, it didn't work out for shareholders, did it? Because their business model didn't work in a fast transition. So what we are saying now is we have different data sets for transition. We have one data set where we say this measures alignment, right? So you measure which companies are well aligned with 1.5, 2 degrees aligned and so on. And here we have risk and opportunities where we look at policy pressure, technology opportunities. And there are trade-offs between the two. Yes, there are. There's also overlap, but you do find trade-offs where you can say, look, from an impact perspective, I love that company. It's 1.5 aligned. But I don't think their transition model works. I don't think their business model will do well in the transition. And you might have other companies that say, well, they have a great company. They built new solutions for transition, but they have a high carbon footprint. So there are trade-offs. And as a data provider, we need to show these trade-offs because the investor needs to take an informed decision. If there's a trade-off, do I turn left or right? Because I have to bite the bullet here. How do I decide? There are trade-offs between alignment and risk and return, and we show that in different data sets. That's how we basically be transparent. That's basically our answer.
Thanks, Guido. Chris, your view maybe on the second part of Hortense's question on client demand?
Yeah, I mean, what I was trying to really emphasize is to really emphasize how it's integrated into the overall portfolio management process of the bank, and that it's a mode of investing that's not distinct from other strategies that you're providing to clients. And when you think about it from that perspective and sort of think of the question posed to other approaches or strategies, you realize almost the absurdity of the question. You know, could you prove that investing in Swiss equities always outperforms? Can you prove that investing in high dividend stocks always outperforms? These are impossible because sometimes they do, sometimes they don't. It depends on the context. So it's really important to not try to put too much burden on the question of sustainability and performance. But there's all the evidence that Guido points to in terms of data and back testing. I think it's all very valuable as additional insights. But I think the most important thing is to demonstrate how sustainability fits into the overall portfolio management process. We follow the same SAA, TAA, the same risk management process, the same instrument selection process for all of our mandates. And that helps clients understand that this is a mode of investing, but the engine that's really driving the performance, and importantly for banking clients in Switzerland managing the downside risk, is the same across all of our strategies. So that's one thing I'd say. And then the other thing is it's important that it's integrated into your core offering. So our largest offering is the Princely Portfolio. It's a co-investment vehicle with the Princely family of Liechtenstein. It's a multi-asset endowment-like portfolio with a high allocation to private equity, private credit, hedge funds, alternatives, as well as liquid strategies. And we've integrated sustainability into that for a number of years and also made a decarbonization commitment to align it with the Paris Agreement as the default strategy. And so I think it's important that it's part of the default strategy for clients if you as an institution believe that it's material. And then it's not a question of either or, opting in or out. You can demonstrate the long-term performance characteristics of the strategy, and in our case, it's had absolutely no impact on either the performance or, importantly, managing the volatility of the strategy. So I think it's really important that it's integrated into the core offering because clients come to any bank to get advice as to how they should invest. They're not experts on the topic generally of financial investing, much less sustainability. So it's our job as an institution to integrate those elements that we think are material into our core offering because we think it's important.
Thanks a lot, Chris. We have 2 more minutes to go. We might have time for one last quick question from the audience. If not, maybe a very short from me on to you, Chris. Do you see any difference in the response or in terms of client demand, depending on client segments or generations on that type of instruments on products?
Broadly speaking, yes. So we have a subset of clients that we call next gens that are under the age of 40, and they show a high degree of interest in sustainable investing. Also, they're not as concerned about the performance questions as older clients. So the so-called millennials that are aged between 30 and 45, they show the highest degree of interest, and which is a great opportunity for us in terms of the long-term growth. However, I would say what they're particularly concerned about is greenwashing questions. And they're concerned about, does it really make a difference? Does it have an impact? And is the institution selling me this for marketing purposes? So at least for that segment of clients, there's a greater interest. And it's important that, that you demonstrate that it's done strategically, that it's not done simply because you think it's going to sell, but also because you as an institution believe in it and have the foundational principles for it. So I would say the strategy approach that I mentioned as a third point is really important for that set of clients.
Thanks, Chris. So an actual opportunity arising from the next gen shift, like we talked about in the past few years a few times in the market, but under the conditions of credibility on quality, basically, if I summarize what you said.
Yeah, exactly.
Okay. Maybe very briefly, we are at the end of our webinar. I would like to do 2 things. The first one is thank very much our speakers today for sharing their insights and for joining us and for their great presentations. Thank you very much. And the second one is, as a reminder, we have the annual conference of SSF next week in Bern, where we will spend a few hours with also prominent speakers from the FINMA, from the Bank of International Settlements, etc., on the topic of climate risk. So if you're interested in that topic, that can be also an event you may want to attend if you have not registered already. Thank you very much to everybody joining today. Thank you, Guido. Thank you, Chris. And have a great rest of your week and speak soon. Goodbye, everybody.
Thank you. Bye-bye.
See you.
Thank you.